Right now, thousands of UK homes are being quietly flagged with a label that could change everything you thought you knew about property values. And if your postcode falls within certain boundaries on a brand new risk map circulating among lenders and insurers, you could be sitting on a home that is about to become significantly harder to sell, remortgage, or even insure. Hit that subscribe button for UK Housing Watch because we bring you daily updates on exactly these kinds of developments that could make or break your property decisions. This is not some distant threat. This is happening right now across regions from Cornwall to Scotland, and the criteria being used to define high risk are far broader than most people realise. The new mapping system combines flood projections, coastal erosion forecasts, subsidence records, and climate modelling to create a risk profile for every residential property in the country. Imagine you have owned your home for 15 years in a quiet village in Somerset. You have built equity, paid down your mortgage, and planned to downsize for retirement, then suddenly your property appears on this risk map because of updated flood modelling. Your home has never flooded, but the models say there is an elevated probability by 2050, and that triggers the high-risk classification. Here is where it gets serious. This is not just about insurance premiums going up, this is about the fundamental ability to transact on that property. Mortgage lenders are becoming increasingly cautious, and some are refusing to lend altogether on certain postcodes. First-time buyers interested in your home suddenly cannot get a mortgage approved, and without finance, your pool shrinks to cash buyers only, meaning significantly lower offers. But wait, here is the part nobody is talking about. The mapping system does not just affect properties next to rivers or on cliff tops. The data pulls in factors homeowners never considered, including clay content affecting subsidence risk, proximity to historical mining activity, and projected groundwater changes. Properties in areas always considered safe are suddenly caught in these classifications. Picture this scenario playing out across the Midlands. A retired couple planning to sell their semi-detached house bought in '92 have watched Rightmove and Zoopla, seen similar properties at $240,000, and put a deposit on a retirement bungalow. Then their buyer's mortgage gets declined because the lender flags their postcode for subsidence concerns from historical coal mining. No cracks, no structural issues, but the risk map cares about zones and probabilities. The sale collapses, they lose their deposit, and they are stuck with a property harder to sell than imagined. For renters, think again if you believe this does not affect you. Landlords with buy-to-let properties in high-risk zones face climbing insurance premiums and uncertain remortgage options. When numbers stop working, landlords sell, rental supply drops, and rents surge. We are seeing this in coastal towns where erosion risk has been mapped, with tenants facing rent increases of 20 or 30%. Here is another twist nobody connected yet. Developers are acutely aware of these maps because they affect planning permissions and saleability. New housing supply is concentrating in lower-risk areas, leaving high-risk zones with less development and declining housing stock quality. This creates a two-tier market where safe zones become expensive while high-risk zones stagnate. Here is something else crucial. The way these maps are used is not standardized. Different lenders use different thresholds, creating chaos where one lender approves what another rejects. Estate agents say this uncertainty is causing more sales to fall through at the mortgage stage than ever before. For pensioners, this presents difficult dilemmas. Many have wealth tied in homes and plan to release equity through downsizing or equity release products. But equity release providers are extremely risk-sensitive. If your home falls into a high-risk zone, your options become severely limited, fundamentally changing retirement planning. We have heard from viewers months away from completing equity release who had providers withdraw offers after risk assessments flagged concerns. The council tax angle matters too. Properties in high-risk areas may require more infrastructure investment and emergency resources. While nothing official links council tax to risk classifications yet, it is not hard to imagine future levies for homes in high-risk zones. Now here is perhaps the most important twist. The data underlying these maps constantly updates, meaning boundaries are not fixed. A low-risk property today could be reclassified next year. This makes long-term planning incredibly difficult. Should you do that loft conversion if reclassification looms? The EPC situation adds complexity. Many high-risk areas have older housing with poor energy ratings. Homeowners face double pressure, needing to invest in efficiency improvements while uncertain whether property values will hold. Spending $20,000 on insulation and heat pumps makes sense if your property appreciates, but not if there are questions over future saleability. Landlords need EPC Band C by 2028, but are reluctant to invest in properties difficult to remortgage. Many are selling now, reducing rental supply further. For first-time buyers, properties in high-risk zones might be more affordable, presenting opportunities for those with larger deposits less reliant on mortgages. But buying there is essentially betting the risk will not materialize or future solutions will emerge. The savvy approach is researching not just the property, but the postcode, checking flood maps, subsidence records, and talking to insurance brokers. The repossessions angle needs addressing. When homeowners cannot remortgage at affordable rates, some fall into difficulty. If rates stay elevated and lenders avoid certain postcodes, we could see repossession clusters in high-risk areas, creating negative feedback loops dragging down prices further. Regional disparities are stark. London and the South East are relatively well positioned with lower environmental risk profiles. The same cannot be said for the east of England, coastal areas, and former mining communities. Property wealth may become even more geographically concentrated. For homeowners deciding now if you are in a high-risk zone and thinking of selling soon, there is an argument for moving before classifications become widely understood and restrictions tighten. If borderline, monitor closely and talk to mortgage brokers about remortgage options. If clearly low risk, your position has strengthened. Here is the final twist keeping analysts awake. Climate projections extend 30 to 100 years. No one knows with certainty which properties will flood or erode. These are probabilistic models, not predictions, and models can be wrong. We are making massive financial decisions based on evolving understanding of future changes. Ignoring this is not an option because institutions controlling property finance are definitely not ignoring it. The entire landscape of UK property ownership is shifting, and homeowners who come out best will be those who stayed informed and planned carefully. Keep watching UK Housing Watch because we will be tracking these critical developments closely as they unfold, bringing you the essential local detail and broader national context you need to navigate whatever comes next in this rapidly changing property landscape. Now I want to hear from you in the comments below. Has your area been flagged on any of these new risk maps? And what exactly are you seeing happening on the ground where you live?